Good morning, everyone, and welcome to the Moneycontrol live stream. You're watching another edition of Markets with Santo and CJ. Apologies first off for the delay. We had some bit of technical issues, so apologies for that. But moving on, we have had the rate hike, but what would be the implication of that on the market? Yesterday, we are putting in the spotlight today the U.S. Federal Reserve now once again, of course, given the fact that yesterday you had the U.S. Federal Reserve hiking interest rates by another 50 basis points, now bringing the Fed's funds rate to about 4.25 to 4.50 at this point of time. Also, more importantly, of course, given the fact that the 50 basis point hike was largely factored in by the market, everybody was watching out for what US Fed Chief Jerome Powell will suggest or talk about in his press conference. And if you look at the overall tone of that press conference, it was generally very, very hawkish, or more hawkish at least than what the market or investors were expecting. After 2 solid months of inflation data, we saw that inflation had been softening in the US. But Powell said that at this point of time, it will not be appropriate to slow down any the pace of rate hikes going ahead. He was basically asked whether the Fed needed to raise rates even at 50 basis points, given the fact that historically, if you look at history, 50 basis points is still a very large rate hike from the Fed's perspective. That said, he also suggested that we have not yet formed a view or taken any sort of thoughts on the size of the rate hike come the January or February monetary policy meeting. So that has led some investors to believe that if inflation were to soften furthermore in December and possibly in January, then you could see the Fed toning down its rate hike pace to about 25 basis points in the January meeting, and that should be largely closer to the sort of pivot that the market has been hoping for. Now, once the policy meeting ended and of course the press conference ended, bond traders started to actually pencil in a 25 basis point rate hike in the next meeting. The odds of that have now jumped to 60% at this juncture. They are also betting that the Fed will cut rates later in 2023, even though Powell categorically said that we at this point of time are not even thinking about any sort of rate cuts, even though the general economy is slowing down. So given the current scenario, it seems like the market's bet that the Fed will pause on the rate hikes is likely to come true by the month of March, and from there on we would see a long pause before the market expects the Fed to cut rates probably by November.
Well, CJ, I think there's a saying that don't fight the Fed. The market has done that and gotten away with it quite a few times, and that's probably emboldening them. Even if Fed decides to reduce the quantum, the size of the rate hike, that would still, I would say, be kind of a death by 1,000 cuts. It can continue to keep raising rates because it's been saying time and time again that we won't pause till inflation is brought under control, and so far there are no signs of that. Yes, there is some bit of easing at the margins, but very clearly it does look like the battle against inflation will be a long drawn one, and it's the labor market probably which is causing a bit of trouble to Fed at this point in time. Despite best efforts, the labor market remains quite tight, and that's something beyond the Fed's control. But let's be clear on one thing, CJ, a buoyant stock market is clearly not going to help the cause of the Fed in its fight against inflation. And so I think we could probably, the Fed may come good on its word to have more rate hikes, and right now the terminal rate, that's the final point at which the Fed stops hiking rates, is seen as 5.1%. which is slightly above what the market has been expecting.
Yeah, I think, Santo, there are 2 points of differences here. Of course, first point here being that the Fed should care not about the market but about the economy. If the economy is giving signals that there is a recession likely to come over the next 6 months, then the Fed needs to start preparing for that instead of caring about whether financial conditions or whether the stock market is booming or not booming. I don't think that should be the premise. A lot of people will say that should not be the premise on which monetary policy should be based. And secondly, this is a Fed that is still fighting a credibility battle, Santo, because remember, same time last year, the Fed was saying that inflation was transitory. It was not going to be entrenched, and then it had to be proven. It got itself proven wrong when inflation continued to remain high, even as a lot of the supply chain issues started to sort itself out. So at this point of time, the market really has no belief to no grounds actually to have the belief that the Fed will turn out to be right, in the sense that suggesting that the inflation has not softened that much, and that recession is not maybe that big a threat to not cut rates later in 2023. So at this point of time, last time around, market was right. It won the battle against the Fed in suggesting that the Fed will have to start hiking rates soon, and it seems like this time around it may also be proven right.
Well, with that we move into the market setup, CJ.
Well, the market setup is looking a bit negative this morning, Santo. If you look at the SGX Nifty futures, they are indicating a very softish or negative start for benchmark indices, taking cues, of course, from Wall Street and the Asian markets earlier this morning. Now, Wall Street ended lower, although the sell-off was not really that deep despite the hawkish commentary that we saw, but still all three major benchmark indices there ended in the red territory. Crucially though, the US bond market and the dollar market did not react too much. Of course, there was a lot of volatility, but ultimately if you look at the closing levels, they were largely unchanged from the previous session. So I think the bond market and the forex market clearly trying to read between the lines as far as the Fed is concerned. So overall, the setup looks a bit weak at this point of time.
Definitely, but again, the near-term trend continues to remain positive, I would say. There is plenty of liquidity in the system, and I've been saying time and again, there's no negative triggers so far at this point. Besides that, going by technical factors, the Nifty has been holding up pretty well above 18,400, and that's being seen as a big positive. So if the Nifty manages to hold that level, the general view in the market is that you will continue to see strength in small and mid caps as
Absolutely,
well.
Santo. Thank you for that. That said, moving on to the newsmakers of the day, and the first one is IRCTC. Now, the stock is likely to be in focus after reports came out that the government is looking to sell a minor stake in the company. Now, the government is likely to sell the stake through the offer for sale route. Remember, about 7 to 8 months ago, back in March, there were rumors that the government would be looking to sell, stake through the OFS route. At this point of time, the government currently holds about 67, little over 67% stake in the company at this juncture.
Well, Shreyas Shipping is my newsmaker of the day. The company has signed a memorandum of agreement to sell one of its motor vessels, that is SSL Chennai. The financial details of the transaction have not yet been disclosed.
Well, Santo, moving on to your top brokerage bet of the day.
Well, HDFC Life by CLSA. The brokerage has rated the stock a buy and has also raised its price target from 690 rupees to 710 rupees. Now, CLSA is bullish on the overall insurance sector, and according to the brokerage, the risk reward ratio is getting quite favorable, and the fundamentals are changing for the better, and CLSA is hopeful that the insurance sector, the life insurance sector in particular, will outperform the rest of the market in CY23 as valuations are quite undemanding at this point in time.
Well, solid views coming out from CLSA there. The top brokerage bet for me would be SRF, but before coming to that, we should check the market out, because we have the opening bell ringing, and it has been a negative start as expected. The Sensex and the Nifty down about 0.3% each at this point of time.
Well, the mid caps and small caps still seem to be doing better than the large caps. We have 1260 stocks up and 640 stocks down at this point in time. Nifty Bank is down slightly. Hindustan Lever among the losers in early trade, down about 0.2%. Bajaj Auto is down by close to about 0.1%.
Yeah, and Santo, sectorally, Nifty IT, Nifty FMCG, Nifty Auto, Nifty Metal, all of them are right now in the red territory. So clearly, it seems like at least sectorally, it is quite a broad-based selling. The only indices right now in the green territory is the Nifty Media and the Nifty Realty space. Realty seems to be, finding some bargain hunters, attracting some bargain hunters at this point of time. Coming back to my top brokerage bet of the day, and that is SRF. Now, a report came out from Phillip Capital, which has retained a buy rating on the counter and a price target of about 3,100 rupees. Now, according to them, of course, they had a meeting with the management recently to discuss the challenges that are cropping up in the sector and their the bullishness to go ahead with a capex plan of as much as 18,000 crores over the next 5 to 7 years. Now, according to analysts at Phillip Capital, after the meeting, they were quite confident that SRF could see earnings growth of our annualized earnings growth of 37% in the coming years, despite the fact that there are near-term challenges across some of the verticals of the company. Now, the specialty business is, has been the crowning jewel for SRF, and there Phillip Capital is of the view that the specialty business is well placed to capitalize on the current global environment and sustain the growth rate that it has been seeing over the past 5 years. Remember, SRF specialty chem business has risen almost five-fold since 2017 to between 2017 and 2020. So that is where most of the growth is expected to come from for SRF, and also Phillip Capital believes that in the next 2 to 3 years you will see the specialty businesses sales more than doubling going ahead, and clearly then you would see another acceleration of growth for SRF. So clearly one of the most sought after stock in the specialty chemical space, SRF, getting a very strong call from Phillip Capital.
And with that, we move on to the stocks on our watch list this morning, starting with IRCTC. As CJ mentioned a short while back, the government has given approval for the OFS issue, and the price for that is around 680 rupees. So that should come as a bit of a disappointment for the market, CJ, I would think, given that the OFS price is at a discount to the market price, and besides that, already you're seeing that the stock has been struggling quite a bit since after it peaked out in October last year. Of course, it has rallied quite well from its June lows. It's risen by close to about 30% but it's now once again stuck in a range, and the reasons for that is that its main engine, which is that internet ticketing, that's where the maximum margins seem to come from. And according to Moneycontrol Pro, this year you could see a very strong jump there in terms of, given that there's also a base effect that is coming into play and pent up demand. But going forward, that might not be, the growth may moderate, and if you look at the other businesses such as catering, rail neer and all, the margins are not as good as what you get in internet ticketing, and there, unless you increase the convenience fee, probably it's very unlikely that you will see the same kind of growth that you had seen till a couple of years back, and that makes the expensive valuation, the premium valuations, quite hard to justify. Also, CJ, institutional investors have not really been coming back to the stock in a big way. They held about close to 20%, FIs and domestic put together, back in June of 2021. Right now the number is closer to about 11 to 12%. There's been slight increase. In fact, domestic institutions have increased their stakes slightly, but even then that's not saying much.
Well, Santo, I think I have a little different view on this OFS, because while it may, at this point of time keep the stock under pressure, given the fact that it generally tends to happen at a discount, I think the OFS actually was a major overhang on the performance of the stock, and I think with that probably now out of the way, it should actually clear the pathway for a good re-rating on this counter, because if you look at the fundamentals of IRCTC, there has been a marked improvement there compared to where we were in FY22. Now FY22, FY21 were both ravaged by the COVID-19 pandemic, but in recent quarters we have seen a very meaningful improvement in earnings of IRCTC. Demand scenario is likely to remain quite robust. If you look at what is happening across railway stations and airports across the country, clearly we are seeing that people are venturing out after almost 6 to 7 months of reopening of the economy. And given that the demand scenario is going to be quite strong, and given the recent improvement in the earnings momentum for the company, I feel that with the OFS out of the way, you could now see some investors maybe finding value on this counter and rally developing on this counter going ahead. The stock on my radar today would be Punawala Fincorp. Now, major news coming out from the company, wherein they have now executed the sale of their housing finance subsidiary to TPG at a valuation of about 3,900 crores. Now, the reason why they wanted to get out of this business, because they wanted to focus on their core lending business, which is on the MSME and the small businesses front. So according to Punawala Fincorp, the money that they will be able to raise from this should allow to improve growth rates in the core business, that is the SME lending and small business lending. Now, the company has indicated that they are expecting almost 35 to 40% growth in asset under management over the next 3 to 4 years. So that will be a very strong growth track record. They want to leverage on their technology innovations as well as product innovation going ahead to be able to improve their overall growth rates and earnings trajectory. Also, asset quality front, they are quite optimistic that they can bring down net NPA levels to below 1% of their total loan book, which will be, of course, a big trigger for any sort of re-rating on the stock. So a lot of positive commentary coming out from Punawala Fincorp, and it'll be interesting to see if the stocks react positively to this news.
Well, on the positive side, CJ, the profits of the company have been steadily rising over the last few quarters, and that's also reflected in the outperformance in its stock over the last year or so. But on the flip side, I would argue that at close to about 4 times its book value, the stock is not what I would call exactly cheap. And also, let's not forget, and this is I'm borrowing from your own argument, CJ, interest rates are rising, and typically when interest rates tend to rise, it's NBFCs which tend to get hurt more. That's also because they are largely borrowing from the wholesale market, unlike banks which have a cushion in the form of low cost savings account and current account deposits. And lastly, I would say that the stock has done very well over the last 1 year, but at the same time is not really been driven by any kind of institutional interest there, that it's largely the domestic traders which seem to have taken a shine for the stock. Institutional holdings in the stock, they have not declined in a big way, but they have not risen either, which indicates that it's largely the domestic traders which are pushing up the stock at this point. Well, last stock on my watch list this morning is Bharat Forge. The company recently held an analyst meet with most analysts have come out quite positive on the stock, which is also doing quite well, and right now it's close to at an all-time high. It's been struggling for the last 3-4 years, but since if you've been holding the stock since 2018, maybe the gains are not much, but finally the stock appears to be showing some signs of a breakout. According to the management, they're looking at a compounded revenue growth of close to 12 to 15% over the next 8 years, and they also expect margins to be above 20%. They intend to reach that kind of profit margin largely by sweating their assets, and also they are hopeful of increased profits from their overseas subsidiary. And the company has also said that it has secured close to about 70%, it has contracted revenues for 70% of its FY25 target, and also that its domestic industrial business is on a very strong footing. It's also looking to ramp up many of its new businesses, that is defense, aerospace, aluminum forgings, and GM Autocast.
Santo, I think no doubts that of course there has been a marked improvement in Bharat Forge's earnings performance, but I think a key aspect of the business is of course the US Class 8 equipment manufacturers there, and although the Class 8 truck sales did see a bit of recovery in the month of August to October, it seems lately it has again started to taper off, and with an expectation of a recession in the US next year, I think that side of the business, the outlook there could be very adversely affected. Also, let's not forget that while the company has benefited, the stock run has also been on the back of the optimism around the defense side of the budget of the company. I think at this point of time is still not a meaningful contributor to the company's overall revenues. The overall revenues still largely depend on the export business, and the outlook there I think will continue to deteriorate as we head towards FY24. So in my opinion, I think the best of the run on this counter probably has been had. We could see some bit of consolidation till we see more evidence of the defense side of the business starting to contribute more meaningfully to the overall revenue pie. And moving on to some of the stock queries coming in from our viewers, and one of our viewers, Santo, wants our thoughts on Karur Vysya Bank. Now, this is a lender which has seen a stellar year, YTD gains of 150% almost. I think generally, it has ridden the wave of buying that we have seen a lot of mid-cap and small-cap banks in general. So his question was whether it will be the right time to accumulate. Of course, Adi, you should do your own research in terms of whether you want to invest or you should take advice from a learned or a professional investment advice. But what we can tell is, of course, the outlook at this point of time looks quite decent on Karur Vysya Bank. The company has seen quite a marked improvement as far as the asset quality is concerned, and loan growth also was showing decent amount of traction in the past few quarters.
Well, the new management certainly appears to be shaking up things out there, but I would only be cautious on one thing. The stock has seen a very rapid run up over the last 3 or 4 months. It's almost more than doubled at almost 2.5 times. So that's quite a steep jump, and those kind of gains to be sustained, you need consistent improvement in the fundamentals, which will again take some time to catch up. Yes, there is a turnaround there, but at this point in time, given that the stock has run up quite sharply, probably you could see some bit of profit taking, at least in the near term.
Yeah, I think the entry point could be, you could probably get some, a better entry point on the stock, given the fact that it's only just 3% away from its 52-week high at this juncture. So probably a better entry point could be on the horizon, given the fact that there you would see, as Santo said, some bit of correction after 150%. That is almost a linear up move on the stock this year.
Well, and with that, we wrap up this edition of Markets with Santo and CJ. Thanks as always for watching and also sending in your queries.
And guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live at 3 p.m. with all the day's trading action. Till then, have a great day.